Hi there, welcome to another live webinar with us from Phillip Nova. This is Sri, your MC for the day. And what will we be covering today? We will be discussing goal outlook and how you can discover the global economic outlook for 2024 and how you can benefit from trading gold. With us today in the studio is our senior market analyst, Priyanka Sachdeva. She's a senior market analyst with Phillip Nova. Early on in her career, she was a trader with one of the largest financial services firm in India, with more than 10 years of experience running trading and hedging strategies, financial modeling and valuations, as well as institutional sales and risk management. Priyanka is well versed in identifying trading and investment opportunities and presenting strategies across all financial asset classes. And currently, Priyanka shares her macroeconomic views on equity indices, commodities, forex with the media, which includes technical analysis for Business Times, interviews with Money FM on their Money in the Market segment. And what will we be, just to share a little bit more about what we will be covering today. We'll be discussing how, with the rate cuts expected to take place really soon against a backdrop of geopolitical tensions seen around the world, gold prices have been on the move on the tail end of 2023. In this webinar, our senior market analyst Priyanka Sachdeva will walk you through the fundamentals shaping gold, discuss technical outlook for gold in 2024, and share some trading strategies you can consider for gold. In this outline, we will have fundamentals shaping gold, gold appeal as a safe haven, gold trading strategies, gold's technical outlook 2024, and the gold products we offer. Priyanka, if you're all set to go, I can hand the time over to you now. Priyanka, please.
Thank you so much, Shri, and a very good evening and warm welcome to everybody listening in, tuning into our Gold webinar, Unveiling Gold's Potential. It will be a deep dive into a contemporary landscape. We will be discussing the historical significance of gold, the vital role it plays in shaping the financial market backdrop, and its enduring resilience as a safe haven asset. So if you are an investor, a fund manager, or just passionate about trading gold and looking for answers on how to benefit from gold trading, today's session is just for you. We will be discovering why gold continues to be the cornerstone of portfolio diversification and wealth preservation. And just to share a brief glimpse of, what we will be covering today. I will be taking you through the reasons why gold continue to be a cult favorite. Why is it has that significant enduring safe haven appeal? What are the fundamentals that impact gold and how they actually shape the trajectory of gold pricing? I will also share a little bit of the global economic outlook and how it's shaping fluctuations in gold right now. We will be discussing deeply certain gold correlated assets and how you drive on to have trading ideas originating from those relations. And I will be also covering deeply into the certain gold trading strategies that you as an investor can apply in current market scenario. And I'll be finishing off the presentation with a technical perspective on gold. And in the end, I will take a brief time to introduce you some of the CME gold products that you can trade with Phillip Nova. Moving ahead, I would, like to, before as an investor, you can make up your mind in gold. It's important to know how good lucrative asset gold is. Why is it world's oldest safest asset, and it's always thriving in the times of uncertainty? Gold has an enduring appeal, historical significance, and primarily there are 5 reasons why it is their cult favorite. So I'll be taking you briefly to all these points. The first one will be economic stability. In an unpredictable world of finance where market fluctuations and economic crises can strike us without any warning, Gold is a symbol of stability, and it's not a new phenomena. Gold has been enduring crisis since history. A recent example would be during the recession of 2008, where stock markets plunged and we witnessed gold surging. So every time there is an economic downturn, investors turn to gold for its stability. It's timeless resource that investors can rely into. The next would be its inflation protection. It's a proven historic against hedge against inflation. Uh, Gold has an intrinsic value, and unlike the traditional currencies, when governments can print more money, pump into the economies, and they actually lose their intrinsic value. But gold, since it's a scarce commodity and has a limited supply which cannot be changed or altered on the basis of demand, the real value or the intrinsic value of gold never goes away, and that's why it is a perfect hedge against inflation. Gold also provides us with diversification benefits. Gold is inversely correlated to most of the majority risky assets like stocks, shares, bonds, even the hybrid products like ETFs or cryptos that we see these days. So basically, since it's a inversely related product, it provides a balancing effect to your portfolio whenever there is a downturn or a devaluation occurs. So the diversification benefits that you get by trading in gold is also one of the key reasons why people trust in gold. Crisis resilience, I mean, who doesn't know the history of gold? And every time there is a downturn, like recently if we see, it was hit by COVID, and every time there is a uncertainty, a crisis, a war like situation, gold surge. Gold is shining bright in times of uncertainties. And last but not the least is the global demand. I mean, gold is, we have to understand, it's not just an investable asset, it's a basic commodity which is demanded by every single household on daily basis. It's used in electronics, it's used in various industries, it's used in dentistry. So basically it enhance, all these reasons enhance the desirability of gold in it. So if I have to conclude, these are quite a lot of more benefits than all these five. Like I mentioned five here, but there are many more, like its ease of liquidation. I mean, it is an asset, but it is considered as liquid as cash. So despite being a commodity, it never loses its liquidation value. So all these reasons makes gold a very interesting or a safe haven asset, and historically the returns that you get from gold is a testimony to it. So just look at the chart here. I've taken, I mean, if you actually denote last 50 years or 5 decades from January 1971 to December 2023, gold has an average annual return of 7.6%. Now, a lot of people or economists will debate that this is much lesser than what you make in equities or what you make in risky assets. But the point here is that gold is a safe haven. It does not really count it as a risky asset. It is invested for its endurance against uncertainties. It even gives you a trusted return when equities or risky assets are not performing. If you look at the chart here of last 20 years, gold has given us a return of about 11.2%. It recently reached, I mean, in December 2023, it reached its lifetime high of 2152 when following the Middle Eastern crisis between Israel and Hamas. So without any, it endured COVID, it endured the Russia-Ukraine war, and every time that happened, gold surged. So we can safely conclude that it really entertains us as a safe haven asset. Gold has, if you look at the chart, it's like literally biased on the upside. So gold has been making higher highs all through this century, and we are actually entering a 25th year of a bull market for gold. And in 2023, gold did not trade below $1800 mark after making a triple bottom around low 1600s. And this year so far into 2024, it's averaging around the dollar mark of 2000. So I can safely say that it is trending upwards. The biasness of it is definitely on the upside. Now, it's very important to understand that there are certain factors that drive the performance of gold. So, if you really want to invest into gold, you need to understand what market moving events or what fluctuations actually cause or drive the pricing in the gold. So let me just take you through what all affect the pricing of gold. So current, I would say the global economy stands at an inflection point after enduring COVID and Russia-Ukraine war and Israel-Hamas. And the biggest one was the central banks when they stepped up their aggressive fight against inflation. Gold is a dollar denominated asset. So basically, whenever Fed starts raising rate or dollar has a dominance, it works bearish for gold. It is a scarce commodity, so its production or mining cannot start like overnight or just in a day, and you cannot um, ramp up supplies matching demand. So the pricing of gold is more dependent on what the demand is, the monetary policy, the global economic conditions. If there are stability in banking structure or the economic conditions, generally equities tend to perform better. So it is bearish for gold. Whereas if you have presence of uncertainty or ambiguity or larger volatility, or there are geopolitical crises, and then it is bullish for gold because people tend to stay cautious of risky assets and move their fund flow into the gold. So these are, I would say, sum up the basic factors that affect how gold pricing is shaped. Now, before we go into deeper into trading strategies or how you should be trading gold, I would like you to go through a basic of what's happening currently in our global economic backdrop and how I feel this will shape the trajectory of gold in 2024. So, uh, the interplay between inflation and central banks, how central banks are going to design their monetary policy going forward, will be the key determinant of gold performance and the overall outlook of gold. In the beginning of 2024, I feel markets deeply believed that inflation is going to go down, but the leading indicators that came in, like the US CPI and the PPI that followed, basically are telling a consistent story of moderation in inflation. I mean, deflation is happening, it is real. But the desired pace at which markets anticipated the inflation to go down, that's not happening. US inflation is primarily over the acceptable limits of 2%, and I would say the risk of inflation is not completely neutralized. And in current scenario, no central banks will actually want to lose their grip on inflation so far. I mean, they won't be rushing to drop down their rates, I don't think so, especially at the backdrop where geopolitical crisis is adding enough impetus for Fed to keep the rates higher. So I would say it's not advisable that we eliminate the prospect of a mild recession in 2024 as yet, and we would the start assuming that Fed will pivot very soon. I don't think that's going to happen, and I personally feel that at least for the first half of year of 2024, the Fed's monetary policy will stay tight. So we are not seeing those cuts that soon like the way we expected. Now markets generally are futuristic, so we need to have a constant watch, and sometimes things like economic indicators. Sometimes, even if you're so bullish about gold flight or anything, sometimes there are pullbacks to it. And the recent US inflation that came in was like gifted like a volatility, valentine of volatility for gold. The CPI report that just came in pushed investors to reconsider their optimistic rate cut narrative. I mean, there were markets at a point, they were already discussing the first cut as soon as March, and they were pricing almost the cuts of over 6 to 8 times in 2024. But I don't think that's going to happen. The PPI report that followed, US PPI report that followed, was even more unpleasant. And currently, I think that's kind of putting Feds so far work on inflation in jeopardy. The rate cut expectations that were somewhere around like 6 to 8 cuts in the beginning of the year have just confined to about 4 cuts probably in 2024. So basically, it's a combination of Fed rates and inflation which will be shaping gold. So no one says that we are moving towards a hard landing, but I will not say that soft landing. We should, as an investor, we should accept that yes, it is a soft landing. I think there is a possibility of a little gray area here and there, and till the point Fed is going to keep its monetary policy tight, we will have headwinds on gold. I mean, whatever correction we are witnessing in gold right now is more of a consolidation, which I won't say it's bad. I mean, it's not really bad that gold is consolidating. It's technically correct, and there is geopolitical flare up which is ensuring that gold should be used as a portfolio diversifier. And as unless and until we have clarity over when is the timeline the Fed is going to cut, I think the consolidation so far is uptrending. It is biased towards upside, but yes, that consolidation is happening range bound, and that's what is going to be for some time. There is another factor which is Chinese equities. So I feel a lot of Chinese markets, or probably the Hong Kong markets, they witnessed a lot of offloading in equities last year. So I would say investors are still cautious, and a lot of money is parked on the sidelines, which is highly likely to land into gold because of the geopolitics. Unless and until we have clarity over these things, I don't think people are going back to risky assets that soon. And there is another talk of stimulus being introduced by Chinese government. I mean, China is the leader of gold demand. So if that happens and Chinese economy somehow stabilize and there is extended stimulus, the basic gold demand from China might increase by the year end. So what I want to say here is that the broader consensus for gold, in my opinion, would be a mild recession for 2024 with a greater upside potential for gold as compared to the downside risk. And I am backing my notion with two very strong points. That will be central bank buying spree, which I suspect is going to continue, as well as the Fed rate cuts, which is inevitable. Though the timeline is missing, but Fed rates cuts will come into 2024. So let's just discuss them one by one in detail. Now, central banks have been buying and shunning away from US dollar reserves to the gold reserves. Now, this is very attractive for central banks because A, it helps them to diversify their reserves. It improves their balance sheet. I mean, it's not dependent only on US reserves. So gold reserves improves their balance sheet. Plus, gold is considered equivalent to having cash. It is equally liquid. So it is a reserve without any credit risk. So for all these reasons, if you ask me, will central banks continue to have the appetite for gold? Yes, my answer would be yes, a big yes. And that's one of the precise reasons why I feel gold will be biased upside. If you I just came across this beautiful chart from World Gold Council, and central banks have turned to be net buyers since 2010. They had been net sellers for gold for multiple decades, and they have switched to net buyers, and the pace of their accumulation is also growing. Not just the total cumulative gold demand by central bank, but the pace at which they are adding gold reserves is also going, and this is going to support gold big time in 2024. So if you ask me what is, according to me, the gold's trajectory, well, it's definitely inclined upwards. I personally feel this is going to hold, but there is always a but. So I would say geopolitical crisis and central bank buying spree will continue to extend upward bias, while the strength of the dollar, which is backed by Fed's not cutting rates soon, will be a persistent headwind to gold. So of course there will be a gain, but that gain is capped. So what is missing is the clarity on Fed rate. At this stage, I want to share this interesting graph by JP Morgan. I picked it up from their site. So here, if you can see, the chart denotes the the vertical line, blue line, zero at zero represents the first day of rate cuts by Federal Reserve, and they have plotted past three rate cut regimes by Federal Reserve in 2001, 2007, and 2019. So if we say, as in the day pass after the first rate cut, gold actually flourished. In all past three instances, gold flourished. So nothing will change for gold even in 2024. This will continue, Fed rates will cut, and gold will flourish. But yes, what missing is the timeline, as I just told you. We are still debating, or the markets are still debating, when is that going to happen. Maybe second half of the year or the end of the year, depends on inflation rate and depends on how Fed actually forced to do this, or they willingly do this. Because if even if there is a scenario of higher for longer rates, that will introduce mild recession, and Fed might be forced to cut rates sooner also. So what matters right now is how Fed is going to react to current market dynamics and how soon they will start cutting rates. But both of these points, central bank buying and Fed rate cuts, are deeply supporting gold at around level of $2,000 mark. So hopefully, I think I have covered a lot of basics, and I will like you to take to the interesting part of this webinar, Trading 101. And the major strategies that I have experienced in my course of trading experience are broadly divided into four different categories. So first will be cues from inversely related assets. So here you anticipate taking position in gold by studying the inversely rated or related assets and how they are performing, and then you take a counter position in gold to make profits. The second would be speculative strategies, where you take one-sided positions based on your perception of future price projections. So say if you are bullish about gold, you will enter a long position, whereas if you're bearish about gold, you will enter a short position. Another term of strategies that I have traded are the called arbitrage strategies, in which you take balancing both sided positions and you actually make profit because of the discrepancies arising in two contracts on probably two different exchanges with the same underlying gold. The fourth and the more deeper strategies that we as traders have used are called using technical indicators like use of charts, using support resistance zones, using technical indicators like RSI or moving averages to decide the entry point or exit point of gold strategies. So I'll be giving you example and explaining you with the help of some charts how I devise these strategies and how you can also devise these strategies as an investor. So my first and foremost, the favorite one was gold versus dollar index. Plotting a historical chart, we can clearly see that there is a negative relationship between gold and dollar. By the way, I've taken this chart from capital.com just for the ease. So gold is basically a scarce commodity and is denominated in dollars. So every time the dollar rises against the basket of currencies, or so basically it makes investing in gold expensive relatively. So if you are an investor in other currency as compared to gold, it becomes expensive and thus it weigh on the prices of the gold. So as an investor, if you see that there, if you perceive or if you have a view on dollar index or dollar pricing or dollar's behavior against the basket of currencies, you simply take a counter position in gold. So say if you say that dollar is going up, you will sell gold and make profit. Or if you're seeing that dollar is going to go down, you can simply buy gold because they are negatively related. This strategy can also be widely used to mitigate the loss on your portfolio. Say, for example, you're holding a portfolio in US dollar terms, and now you feel that US dollar might rise against the other currencies, or US dollar might just lose against the other currencies. Then you can add gold into your portfolio to mitigate that risk of dollar. So you can derive a lot of strategies if you're watching dollar against gold. Similarly, another favorite of mine is gold versus equities. Like I've taken an S&P chart here just to show. Uh, they are also inversely rated. Very simple logic. Equities are a risky asset. So the minute you see that they are rising, people will take out the funds because gold is a non-yielding asset. So it does not have a coupon, it does not give you any kind of income. So the minute people see that equities is rising, they take out fund from gold and they put in the equities. But on the times of economic downturn, or when there is um, uncertainty, or you see markets are crashing, you can immediately go and buy gold because a lot of fund will flow into this. So this is another strategy you can use. You can, for example, this is very relatable in our current scenario. We have seen a lot of offloading happening in China or Hong Kong or even in US indices. And where is that money gone? That is somewhere parked somewhere, and that will flow into gold. So this is another idea one can use as a gold trader. The other one, a similar inversely rated product, is real yields. And I've just taken a last 4-year chart, and you can seriously see how Fed's monetary policy, when they started tightening, gold flourished. So the minute I'm sorry, so the minute Federal Reserve started tightening their monetary policy, gold flourished. So it's inversely related. So the minute, and now when you're seeing, and now when Fed start, kind of announce that this year they will be cutting rates soon, or there will be monetary easing. So investors have perceived that yes, gold will go up, and we have seen a lot of momentum buying in gold, and so it's also an in inversely rated product that you can watch. So if you see that real yields are going to go down, you can safely invest into gold. So these are in cues from inversely related products, and you can make your own strategies. I'm just trying here to explain through a few examples. Let's move on to some of the speculative strategies. So one of the most interesting one is seasonality. There is certain times in the year when gold is stronger, and there are other times when gold is traditionally weaker. I've plotted a graph, I've taken it from Reuters, and this is like 50-year average. This is like 5 decades of average returns that gold has made per month in an year. So if you look at the chart, in the month of January, February, September, and November, gold has always risen up and has given you much better returns than the average returns. Okay. So as an investor, it's very safe to take a long position in gold during these months. Whereas in the month of March and October, the average returns has been negative and much lower. So you can actually take a short position. Though now there will be debates that this is based on historical chart, and yes, it's based on history, and it's just representing the average returns. And while you take a position, you have to see, or you have to look at the lot of other things that are happening and make an analysis based on expected deviations from month to month performance. However, those deviations will be little because history do tend to balance out. So whatever these numbers are 50 years history. So you can go wrong, but in a limited deviation. Next would be the basic go long with upward bias. That means higher highs or higher lows, and vice versa, go short when you have lower highs and lower lows. So I've just taken this graph from TradingView just as an example. So if you see a trend of lower highs and lower lows, that means it indicates a downward trend. So you take a short position here. Whereas everywhere where you see higher highs and higher lows, like the one in the graph, you take a long position. It's a basic 101 strategy of trading that as an investor you're supposed to look at. So just look at the chart. If you anyhow see lower highs and lower lows, go down. If you see higher highs and higher lows, go up. Simple. Okay, this will be an interesting edition. I have been fairly an arbitrage trader all my life, and arbitrage refers to taking an offsetting position in two different contracts or two different exchanges with the same underlying. That means the quality for example, I'm like sharing here CME gold, Tocom gold, and Thai online gold. So here the specification of gold is same. So that means the underlying you're investing is same. Okay, you go long on one side, you go short on the other side. In net position, you're always zero at all the times. So you're not exposed to any directional price movement risk. What you earn is discrepancies. Now you will ask that why these discrepancies occur when the underlying is same, or why, if it's so easy, why not everybody is doing that? So answer your questions. These discrepancies occurs because of slight difference in the contract sizes, the slight difference between settlement, whether it is deliverable or cash, which currency are you trading in, what is the P&L per tick. So they are traded in different economies, different time zones, and have different trading hours. All of them has different domestic demand, and no matter they are driven by the benchmark, they all derive their prices from benchmark. But because of all these factors, there is discrepancies in matching that price live. And as an investor, you just take opposite positions in two different by balancing them, and you make profit through disc. Sometime there will be a time when all of them will merge to the benchmark pricing, and that is the time when you cross over your position and you book your profit. But most of the times you will find these discrepancies. Now why everybody is not trading it? Because it needs technical know-how. You need to calculate how to balance the difference between contract sizes. You need to have some mathematical knowledge. You have to manage the currency exposure, because you will be dealing in two different currencies, so there will be a risk of currency. So how do you manage that exposure also adds to your profit. So that's why these are not widely traded arbitrage strategies, but they exist. They are majorly very low risk strategies and can be fine-tuned on daily basis because you don't take any directional exposure in this one. So going forward will be taking a technical perspective. I mean, how to read charts to get into it. So I will be sharing you my technical perspective on gold, or what as a trader I will be doing today. When will is the time when dip buys should start accumulating, or when is the point when short sellers should just jump into to make the profit. So I'll explain you how I read the chart. For example, the current one, this is a like 5-year chart, and I have taken a regression from the lows that this is actually upward bias. So I've taken this around 2019, 18, 19 mid from around 1100, $1,200. Gold has recently touched a high of 2150, right? So I've plotted a Fibonacci regression on this, and it's beautiful to see how gold, when Fed started raising rates, come down to drop dot 50% and made triple bottom at 1600. So this drop is not really a trend reversal or a correction. It's considered very good consolidation when it comes to technical perspective. So when this happens, this 400 500 point rally that you witness here actually opens the door for another 500 points upswing. So that means gold, whenever it does manage to consolidate over its new high, it will open doors for another 500%. So the target rate for gold should be somewhere between $2,500, $2,600. Now, if it is that easy, everybody should just go and buy gold, isn't it? No. So definitely gold is trending upward. I've just dropped down to what's happening last year, and it made bottom here, and it again tried to breach. If I just join the line support zone, it's basically an upward channel. So it did try to breach, and again this is a very good technical correction that it took. So that means gold tried to breach the support zone, but it couldn't sustain that breach. That means it proves that it is still trending upwards. Let's go a little more near to what's happening on day-to-day basis. I have plotted three different 50-day moving average, 100-day moving average, and 200-day moving average. It's beautiful to see that in 2024, gold has been sustaining or consolidating over the mark of $200 level, which coincides with the 100-day moving average. And just below that is the support, another support zone of $1980 level, which is the 200-day moving average. And currently today gold is consolidating around $20.40, which is the 50-day moving average. So if you see, all these three are trying to converge somewhere above 2000, so which is going to be a key determinant point of what's going to happen in gold. If gold does sustain consolidation above that level where all these consolidate, it will open doors to new highs, right? And for that time being, the range bound trading, every time it does come down to that $2000 level, it's gonna try and test it, and will be an ideal point for everybody who's trying to enter gold market. So should we all go and buy dollar gold when it drops down to $2000 next time? Well, a lot can happen. There is geopolitical turmoil. There is an alternate scenario of higher for longer race. So a lot will keep shaping gold, but broadly, the bottom line, it is holding support zone at $2000. It needs a consolidation around 2050 for a move, a sustained move towards 2100. Central bank buying and Fed rate cut is the catalyst that is required for gold to do that. I continue to see that there is bullish momentum here. I don't see a massive sell-off. And gold has an historic um, performance against uncertainty. So I don't see any reasons why it's not worth an investment at current landscape. So I would say gold has plenty of reasons to shine, but it doesn't mean bullion is a foolproof investment. Like any other investment, it's important to consider the time frame of investment, when you are entering, why you are entering, how and what market study you have done to understand your entry and exit levels. Have you designed a stop loss? Have you designed what margin requirements are needed? Have you designed how will you diversify your portfolio if something goes wrong? So once you have done all these analysis, I think an overall perspective gives you ample trading strategy opportunities. So before I end, I would like to take some time to go you through the CME Gold Comics futures that we, Phillip Nova, offer and why you should be trading it. So Comics is a subsidiary of CME, which is apparently one of the largest and most active future exchanges in the world. Their contracts are standardized in terms of contract size, delivery date, and the underlying quality of the gold is definitely dependable. So they are a derivative product. That means they give you option to both buy and sell compared to the physical gold. Like you don't have to make a whole investment. They trade on a margin basis. So with a little investment, you can have the exposure on gold without even holding it. And you have options to trade both the sides of the view. And these gold contracts are varied on their delivery dates or sizes, and thus it can be altered to your needs. I mean, not really altered, but it does give you an option, various options to invest. They are highly liquid, they're transparent, they're very flexible, whether you want to take the delivery or you don't want to take the delivery. And the number of hours you can trade it, I mean, 23 hours in a day from Sunday to Friday, 6 p.m. to 5 p.m., which is a very, very long time to actually have a field of trading gold. So there are three different contracts that we offer. Gold standard contract, which is 100 troy ounce. There is an e-mini gold contract, which is 50 troy ounce. And there is a micro gold contract, which is just 10 troy ounce. The margin requirement for trading one lot of standard gold is about USD 9,000, whereas you can trade a micro gold, which is just 1/10 of margin, just $900. All of them have a different tick size and the profit figure, so you can basically understand whichever exposure you want and whichever contract you want. And to make it worth your while, because you attended our seminar together, Phillip Nova is running promotions on micro gold. We are just charging markup of only 98 cents over the exchange fees, and the commissions from per contract is capped at USD 150. And there is a QR code right now on your screen which you can just have a look, or to see what other promotions we offer currently. And I would be very happy to take up any questions that you have on gold now.
All right, Priyanka, thank you so much for the insightful sharing. We let's just give some time for the members of the audience to send in through their questions. In the meantime, can I just get your views on, based on what you've shared for today, what will be the key takeaways for the audience today?
Key takeaways, I would say, I personally feel it's on a uptrend, but it is highly dependent or vulnerable on what Fed policies are going to be or when exactly Federal Reserve will start cutting rates. So it is widely supported at $2000, and there is a safe, I would say, upswing that I expect in the market. So, but it's just my personal view. It is not really something directional from Phillip Nova. It's just based on my personal analysis on technicals that I see. And we are offering promotions on micro gold. So, for a very small charge of margin, our investors can trade into gold and make a lot of strategies out of it.
Okay, so from your time, when you see how the market is panning, what are some of the key events that gold traders should be looking out for, with regard to trading gold contract? Like, what are the upcoming events that we should look out for?
Sure. So Shri, I personally feel Fed's policies have been paramount for driving gold in 2022 and 23 both, and there is constantly Fed commentaries coming in. There is a constant evaluation that is happening on future projections. So Federal Reserve comes up with a beige book, which people, the officials of the Fed, they actually kind of forecast what rates they're expecting in future. So I think all the investors should watch out that uh, tomorrow will be jobless claims from US markets. So that kinds of tells you how what kind of strength US economies or labor market has, because labor markets are a prerequisite. Softening of labor markets is a prerequisite that is required by Federal Reserve to cut rates. So unless and until we see that happening, I don't think Fed is going to cut rates and gold will have its catalyst. So that is missing. So you need to watch out what's happening in US economy. You need to watch out how the labor market is, what is the strength of the labor market. Plus, you also have to watch out if there are any commentaries coming in from federal officials. And to be very honest, they have been making very complicated statements in last few weeks. They say something and they mean actually something else. So it's very important to watch those out. Cues from
Um,
China can also be looked into, Shri, because I feel it's one of the biggest contributors of gold demand. And if there will be stability coming in Chinese equities, then a lot of fund will flow out from gold.
all right, so we have one other question. Mr. Veli Chami is asking, for spot gold, can I buy and keep it in my account without taking the physical gold? Like, as in, can I trade spot gold or gold futures without holding the physical gold?
I don't think that is possible. So spot goals generally comes with a delivery, but I think Philip Nova does have a special contract that we offer. I can send you just we will send you the details to the person who asked the question over the email, where you can actually invest into spot gold pricing without actually holding the gold. So that is possible. But that is like 100% payment, and we give you gold in the paper form and not really the physical delivery. So it will be added to your portfolio, but that's not really spot benchmark gold. That's a different contract.
Hey Priyanka, other than margin requirements, do the investors require to pay holding fees to invest in gold CME contracts for long term, say like 3 to 6 months?
No, not on futures. So futures are primarily based by margin requirements. So you have to basically pay up for the uh, M2M, or the profit and loss that you make on your current standing of the position. But if you do not want to take delivery, there is an option on micro gold. You may not want to take the delivery, so you shift your position to other month's future.
All right, we have a question from the member of the audience. He's asking, where can I obtain commentary on gold?
Actually, we do send out daily commentary. If you're one of the clients of Philip, please sign us, send us an email. We include you. We shoot out daily commentaries on gold. Like I personally write them. I sometimes include the technical perspective on it. You just have to send a request to Philip Nova, or any of the sales channel, through any of the sales channel, to be included in them. It's free of cost, given to all our clients.
All right, and are there any more questions, members of the audience? We still have some time with Priyanka, and she can address all your goal related queries. Um, Priyanka, while we're waiting for more questions from the audience, can I just check, a closely related product, when we look at gold, we often talk about silver. How has been silver moving? Is it in tandem with the gold since the start of the year?
Well, if you talk about 2023, it wasn't in the tandem. Though I was more bullish on silver, and I personally feel when it comes to fund flow into safe haven assets, silver, the sister of gold, will has more momentum. I think the current valuation of silver is much down, but recently, last few weeks, silver did pick up, and it's currently in 2024 is definitely performing well. So if you have asked me this question in 2023, I would say it was underperforming, but it has picked up now. It's in the same direction and now picking up the pace that it didn't had it to 2023.
Yes, so I think that's all the time we have for today. If you have more questions, you can type them in the survey form at the end of the webinar. And for queries that we receive with regard to the gold commentary, we'll get in touch with you with that as well. So basically, it's a free gold report sent out to our customers. Mr. Velachami, you can send us. If you have further questions, you can either send them in the survey form at the end of the webinar, or you can just respond to the email address that I'm typing on my chat screen right now. It is nova@phillip.com.sg. All right, thank you so much for being part of our live webinar. Do look out for our upcoming webinar, which is happening on the 27th. We have two webinars actually that's coming up. One is a Chinese webinar on the 26th, and on the 27th we have smart money strategies for Singapore stocks. If you'd like to take part in these live webinars, you can register for them via this link provided, which I'm typing into the chat box right now. Okay, and that's all the time that we have for today. Thank you so much for your active participation, and see you in our next live webinar. Good
Thank
night.
you very
Take care.
much.
Thank you.